Good afternoon. Welcome to the CFA Research Challenge Local Challenge, the Southern Classic, hosted on behalf of the Atlanta Society of Finance and Investment Professionals, the CFA Society Alabama, and South Carolina. My name is Dyer Kennedy. I was a co-chair for this year's challenge. And we're going to make a short introduction and have the three teams come in and present. First, we'd like to thank our sponsors this year. We have FactSet, who provided you with their platform for researching your subject company. We have Kaplan Schweizer, and we have, of course, CFA Institute. So we want to thank all of them for their continued support. Just a little bit about the format today. I'm going to introduce a little bit about the CFA Research Challenge, which hopefully by now, over the last 6 months, you are well aware. Some about the CFA Institute globally. We would love for you to look into that curriculum and that course of study as you progress through your careers and after your school culminates. We'll go through a rules review, and again, I'll make some more announcements about the volunteers and the judges to get started. So first of all, I want to thank all of our faculty advisors, all of the students, of course, the mentors, the graders, and the judges this year. It really does take a village, and it's a huge compilation of work and effort over many months to get this put together. So there was a lot behind the scenes going on. We want to thank all the volunteers and mentors for their participation, and many are returned volunteers from years prior. Especially want to thank the Southern Classic Committee this year, who put in countless hours. So we have Celia Anderson, co-chair, myself, Aaron Zeta, Anelia Hall, Anthony Lee, Magnolia Shoemaker, Fred Tolley, and Kathy Ford. There were many more who put a lot of work in behind the scenes, and we thank all of you, but this was the committee that was day in and day out and working to make this challenge a success. We also want to thank our judges. We had morning judges this morning. We have an esteemed panel of judges for this afternoon's final round. We have Paula Bello, Portfolio Manager at Voya Investment Management, Keith Hughes, Managing Director at SunTrust Robinson Humphrey, Kurt Kimball, Managing Director at Willamette Management Associates, David Riley, Senior Portfolio Manager of SunTrust Bank, and Steve Davenport, Director of Equity Derivatives at SunTrust Bank. And at this time, I'd like to ask Steve up just for a very quick presentation on one of our initiatives through ASTIP and the ASTIP Foundation.
I just want to say to all of you to check out our website. We've got a website developed for financial literacy, and we've been trying the last 3.5 years to show leadership in the community in approaching financial literacy. And you guys are the leaders. When we look at the overall population of the United States, 30% have a college degree and 20% are in business. So that means that 6% have the skills and knowledge to really approach a lot of these personal finance issues. So when we think about that 6%, I like to think of it as the beginning of a flight. They talk to you about when there's an emergency and there's rough, you take your oxygen mask and attach your oxygen mask first before trying to help others. All of you are going to go out and try to help others in this field. Let's try to make sure that everybody has all the skills and ability they need on their own to succeed and do well, because ultimately your success makes the community stronger, and if you can help others with their financial literacy, it's a real benefit. So check us out at sfip.org/foundation, and congratulations on getting here, and good luck in the future. Thanks.
Thank you, Steve. So a little bit about the final round presentation. There are 3 teams that we just announced as finalists. They will make their investment recommendation based on their research on HT Supply Holdings, our subject company this year. There'll be a 10-minute time limit for the presentation portion, and then another 10-minute time limit for the Q&A portion. The finalist winner will be decided solely on the score from this finals round. Please make sure at this time, cell phones off, and audience members, please hold your applause and remain quiet during the presentation. This time we'd like to recognize especially thank our subject company, HD Supply. They've been, they provide the highest caliber in communication support, presentation throughout this challenge. We've had a great experience with them. We're very appreciative of the partnership that the Atlanta State Finance and Investment Professionals has gained with HD Supply this year. As you can see, I don't have to tell you the company statistics because this is what we've been doing over the last few months, but it's a company based here in Atlanta, and we're very happy to be a partner with them. At this time, I'd like to ask Aaron Zeta, who is a committee member for this year's challenge, but also the treasurer and director of strategic finance at HD Supply, to come up and say a few words.
Thanks, Dyer, and thanks everyone for coming out and participating over the last few months in this research challenge. Whether your recommendation was buy, hold, or sell, I think this is a great experience. Really, hopefully, lets you stretch those critical thinking muscles, presentation skills, and develop some of the fundamental analysis that's going to help you, I think, throughout your career, whether you're talking about working in corporate finance for a company, making sell-side or buy-side recommendations, managing portfolio, or pursuing other endeavors. So HD Supply was really happy to be the subject company this year and participate, and thank you again for all your hard work.
The culmination of this event will have a winner, and the winner will go on to the regional finals, which is in New York City this year, and the global finals is right after that. So we'll be proud to have a representative of Alabama, Georgia, and South Carolina move on to the regional finals. And lastly, before we start the presentations, I just really want to recognize all the students again for your diligence and interest in the financial field, investment field. I think what you've done is shown, a huge and uncommon dedication that will go far for you in life, whether you end up being in the finance and investment field or not. But hopefully you take some of these skills that you've learned with you forward, and we really want to extend our appreciation. If you'd all stand, we'd like to give you a round of applause. That concludes our brief introduction. I will have Anthony go retrieve Team P, who's going to be the first presenter, and we'll cycle through the three teams that way.
Good afternoon, and thank you all for being here. I'm Kate Bagley. This is Edward Nyman, Michael Byron, Cannon Kuipers, and Caleb Carter. So to start off, we have placed a buy recommendation on HD Supply with a target price of $45.38, which is a 17% upside to the price as of our valuation. This recommendation is based off of 5 factors that we will cover, including HD Supply's strong financial agility, the fact that they're an industry champion, their corporate dynamics, risk mitigation techniques, and lastly, the valuation. Now, Kenny Kuipers will talk about the stock performance and a brief company overview.
So looking into their stock performance, we compared HD Supply to the S&P 500 along with the industrials index. And as you can see, over the past 5 years, we've seen consistent growth. And along with this growth, they've also outperformed both the indexes, except for some cases of missed earnings or large macroeconomic effects that did affect the whole industry. Looking further over, we have a chart of their earnings estimated versus reported. And they did beat these estimates 10 out of the last 12 quarters for 3 years. This shows their strong financial ability to outperform the street's expectations. Looking into the industries that they operate in, the first one is maintenance, repair, and operation, or MRO. They provide 60,000 different products, along with next-day delivery and customer training. And the second industry they operate in is construction and industrial, where they really focus on their strong business-to-customer relationship, which really sets them apart from their competitors. They focus on their on-site expertise and their 24/7 ordering on the app. Looking at the segment data, the MRO segment has more flatlined, stable growth, and that's just due to the required and mandatory industry that they work in. And then the construction and industrial segment has larger growth, and that's just due to the heavy dependency on the building industry that they're in.
Thanks, Ken. We're talking a little bit more detail about who is competing against HD Supply and what sort of market they're operating in. So you can see on the right side, the vast majority of the players in the managed repair and operation, as well as construction and industrial, are fondly referred to as mom and pop shops. You have local, regional distributors who operate on a very small geographic basis. And then as you move forward into the scale of HD Supply, you see much larger players, some of which are featured over here on the left side. Even though HD Supply's market capitalization is less than some of its competition, you'll see that they perform very well based on their size and revenue, particularly projected revenue for 2018. Also, their larger market share helps because of economies of scale. They have a much larger footprint, and their supply chain gives them a competitive advantage over many of these smaller players who may not have the benefits of their developed business trying to expand their market share. Additionally, having this large market share gives them, against even only the larger competition, the ability to operate in the mergers and acquisitions field, as well as use their free capital much easier. And now, going on to Michael to talk more about mergers and acquisitions.
Yeah, so like most companies in the MRO, construction, and industrial industry, mergers and acquisitions are a key part to growing as a business. Most recently, HD Supply acquired 8 shares back in March of 2018 for $362 million in cash. When HD Supply is looking to make a new acquisition, they really focus on 3 key objectives. First, they look for a company that has established strong customer and distributor relationships. Since the customer relationships are such a big part to HD Supply and kind of their business model, they want to acquire a company that also feels this way. Secondly, they look for a company with more attractive margins and hopefully one that's going to help increase their operating efficiencies. And lastly, they look for a company that will help increase their geographic footprint, and I'm going to talk a little bit more about that on this side. So with the acquisition of 8 shares, this brought about 50 new locations, mainly to the northeastern part of the United States, and this brought up HD Supply's total amount of locations to nearly 500. They're mainly based in the United States with a few throughout Canada. Overall, we do think this acquisition of 8 shares was definitely positive for the company. As of the end of December, 8 shares had contributed about $360 million of net sales to HD Supply's total revenue. So now Caleb Carter is going to talk about risk.
Thanks, Michael. Yes, so HD Supply faces multiple risks across the board. However, the investment team and I do not believe that any of these risks pose a significant threat to immediate or long-term profitability or growth. We're going to talk about 3 of those right now. First, we're going to start with competition within the industry. As Eddie said a little bit earlier, the industrial supply industries, it's a very fragmented industry where they're competing against not only large-scale industrial suppliers, but also local mom-and-pop shops. And so they're always in a jousting position for market share. However, the investment team and I believe that HD Supply's value-add services, their scale and their competitive pricing mitigate this risk and leave them in a position to grow their market share going forward. Next, we're going to talk about competitor acquisition. Michael just got done talking about how important M&A activity is in this industry. Companies acquire other smaller companies for supply chain efficiencies to enter into new markets and to penetrate existing markets. If HDS ceases to participate in this activity, then they could cede significant amounts of market share to competitors. However, as shown with the A.H. Harris acquisition, they are looking for opportunities to do that and are very active in the market and looking for opportunities going forward. And last, we're going to talk about tariff threats. In 2017, the U.S. government launched a Section 301 investigation into China, and in response to that, they issued specifically a 25% increase or a tariff on steel and a 10% tariff on aluminum. HCS sources a lot of their goods and products from China, and so in effect, those goods, the prices of those goods increased. HCS has absorbed many of those costs. However, if those costs continue to increase, that could have downward pressure on their margins. HCS mitigates this risk through a large international network of suppliers, and we believe they're in a good position going forward. Next, Eddie will be talking about financial agility.
Thanks, Caleb. Since they became a publicly traded corporation, HD Supply has been going through a significant capital restructuring program, reducing their leverage ratio to 2.5 times. Now that's a little bit less than the industry standard of 3.03 times. We believe that this not only just frees up free cash flow, as you can see on the right side of the screen, it gives them a lot more flexibility in their markets to do things that are required of a larger corporation, as we mentioned earlier. The free cash flow can be used, as Michael was mentioning, for mergers and acquisitions. We believe that to be successful in the future, this company is actively pursuing these mergers and acquisitions as they have shown us with the successful A.H. Harris acquisition. Also, free cash flow is being used currently for a stock repurchase program totaling $500 million, which has already begun again last year. It will be bringing value back to shareholders in 2019. This weight off their shoulder essentially lets them operate more smoothly, even though they are a large player. They can move much quicker in the market for a very, very fragmented one where sales is very, very tight, competition is very tight, and it's very hard to get new customers. Additionally, while they are financially flexible, as I said, they have to do what they do best, which is sell. So daily sales growth for the last 2 years has been positive, not only in MRO, which Ken mentioned was very constant, but also in the fluctuating construction and industrial sectors. A company that operates well in sales, as well as financial agility, is one of its tests to succeed. We believe that HGS is one of those. And now getting back into our valuation.
Okay, so moving into the valuation. Something real quick on this slide. As our judges pointed out, the capital weights, they should be switched in that, but then on the left it gets correct. So you see that. Yeah, so we decided to use with the discounted cash flow method and the trading comparables method when coming up with our target price. So with the discounted cash flow, we projected out our cash flows for 6 years, discounted them back by the weighted average cost of capital, as seen on the left. And for the exit EBITDA, part of that, we did a 10 times assumed EBITDA multiple, and for the perpetuity method, it was a 2.25% long-term growth rate. The DCF method came up with a $45.39 target price, contributing 80% to our final price. For the trading comparable side, it was a blend of the next 12 months and last 12 months, and again, using that 10 times assumed EBITDA multiple, and that contributed 20% of our final price of $45.38. We decided to run a Monte Carlo analysis using MATLAB. We performed 10,000 iterations showing the effect on stock price by different variables such as the cost of steel, changes in the GDP, risk-free rate, etc. And that peaked right around our target price as well. On the right, you can see a valuation summary showing the price ranges for both valuation types and the 52-week market high and low. And now Edward will conclude.
Thanks, Kate. As we've shown, I think historically and in the future, this company is a strong investment for anyone looking to receive healthy returns on any of their investments. HG Supply, as we've all mentioned, has incredible financial flexibility and incredible operating practices in their maintenance, repair, and operation and construction and industrial segments. We believe an investment would be sound for a buy, and our target price is $45.38. And we look forward to the continued success of this company in the future. Thank you.
We'll open up to the question and answer session for the judges.
Can you talk to me about how you feel the overall product fits in the macro environment over the next 2 years with China tariffs either going up or down, the possibility of a recession in 2020, or higher interest rates if the actual growth rate of the economy goes up, or if we see slower global growth affect the U.S. economy and we fall into a recession before that?
I think you mentioned a couple things, and I'll try to hit all of them. But you mentioned the possible recession in 2020. Although that isn't guaranteed, I think a possible recession would hit the economy as a whole pretty tough. And companies that usually don't do well in a recession, while there are a lot of them, the investment idea, the investment mindset isn't one that you would single out a single company if the entire economy was going out of the hole. Does that make sense? So if you have
some companies are going to be more cyclical, like 30% of their business is coming from construction, and construction would come to a grinding halt if we had a recession. So
as
it hasn't been around since 2013. I guess we don't really know what it would be like in a recession, right?
And Ken mentioned this, the consistency of the MRO. When you have a fluctuating market like construction and industrial, something that varies with the market cyclically, but then you have a consistent sort of income where you have rental turnovers. So we can assume that even if a recession hits, everyone's going to need somewhere to live. And so rental and maintenance are going to be a constant source of income. Also, what you said, wait, hold on, I lost my train of thought, I apologize. But yeah, even if 30% of the income is coming from construction, I think that a company that operates well in both fields doesn't need to necessarily rely on one arm or the other when it's strong enough to hold up its weight, which is one.
And then with those tariffs, there's a, I think, 25% tariff on steel coming in, and with rebar being a major part of their construction and industrial segment, that's definitely something that kind of, through what we've read, They mentioned that they've increased prices some and have been able to absorb most of those costs. They've definitely, or I guess been able to handle most of those costs, but they've definitely had to absorb some of that as a company. So I guess that's more kind of going forward as we're watching to see how that plays out.
What unique moats do you think this company has relative to its competitors? And by the way, what companies did you use as a comparison for your guideline public companies?
I can take the beginning portion of that. So I would start out with scale of the business. They're nationwide, and with this recent acquisition, they're now a player in the Northeast. Furthermore, they've got their own trucking line, which we believe is a very big deal. And they've made a point to focus on selling more to existing customers because it's cheaper to put 6 of things of a product on a truck than it is just one. And so that's one thing. And then also just value-add services as far as training customers on how to use products, same-day delivery, just that kind of thing that kind of separates them. We believe that has built moats from other competitors.
You just hit on the fact that they've got their own trucking company. There's a lot of talk now on the U.S. facing what they're describing as a crisis in truck drivers. And I was wondering if that's something that's come up in your research and where would you rank that in terms of their threats?
The HD Supply takes it under their wing to diversify the age of their truck drivers. And so they keep age metrics on all their drivers to make sure they're, for the demographic curve, there's not bulge anywhere on any of the younger or older drivers. I know if they are aging out and they're afraid of delay, HD Supply has taken steps to hire younger drivers to make sure that it's hedged against the kind of retiring out of all their drivers.
As well as, like, they don't contract out their trucking since it's them doing it themselves, and they do a very strong company culture, so we believe that their employee retention will remain high and not release their truck drivers.
Are these local delivery or are these long over-the-road delivery types of truck drivers?
They're both. So HD Supply has not only long-term driving fleet, but also on-site delivery and on-site expertise. So they have drivers who will come, but then they have experts who are industry officials, and they'll help with construction, maybe the contractors, whoever's performing the construction project, to make sure they see it from not only the parts that are delivered to its completion.
And then the people who purchase them know how to use the products as well.
So it's
They mentioned too that they have, I think it's 98%, they can reach 98% of the country on next day delivery, so that's another kind of bragging point they hit.
also the geographic footprint of the new acquisitions. That was, Michael mentioned, the Northeast was somewhere where they had incredibly high, obviously, population density. And so just because they had the same amount of branches per geographic density in a square mile, they needed a lot more just to provide for all of their customers.
Yeah, so let's go back to the competitors. You had on your threats analysis, I think it was a 5.
That's fine.
Yeah, so competition within the industry, that's your biggest risk, is that what you're saying? You just go out here.
Yes.
Right, okay. And you highlighted another slide, don't slip to it, you showed that the other competitors were a good bit larger. And I think that was on market cap.
Market cap.
That was a market cap versus revenue. So I guess my question is this. They have larger competitors. Are they larger in revenue? And do they directly overlap with HD Supply? Because I don't think we need to care about market caps and competitors.
Yes, so they're top in their industry, the top 5 in revenue, and they have, I believe, larger revenue than some companies that have larger market caps. Can you repeat the second part of that?
So the question is, how much do those players identify? How much do they directly compete with HD Supply?
It almost simultaneously, like side by side. I know, I can speak from experience. At school, we have, I'm in engineering, so we have pretty significant labs, and all of our maintenance equipment comes in from, you could see probably 3 of those companies. I know W.W. Granger, HD Supply, and also Fastenal. We have the booklets on our desks for all 3 of those companies. And so we order things simultaneously. It was interesting for me taking on this project because I was like, well, looking through the booklet, they look very much the same. However, some of the companies, particularly Ferguson and Fastenal, operate in a much larger, significant multinational field. And so they might have larger market capitalizations, but HD Supply focuses mainly on the United States. And because of that like central core business, which is this country, we think that they can not only specialize, but be the best. And while they don't have the largest revenue, in MRO they are, I think, in the top 3, and then like Caleb said, they're in the top 5 for both of them. So while they aren't the top, because of the things we cited earlier, they can be the best because of how they operate.
When you think about this business and delivering stuff the same day, I only think of one name, and that's Amazon. And I haven't heard you say anything about Amazon as a competitor or as a threat to this business. Can you explain to me what the competitive advantage would be of an HD Supply versus an Amazon who could enter with a great deal of technology and ability in that space?
Yes, sir. So existing infrastructure is one thing. This is an industry you've got to be very specialized. We talked about value-add services that HD Supply brings to the table as far as educating customers on how to use goods, next day delivery.
The bolts and nuts are not really specialized.
However, more advanced products are. Because they serve all, everything on a construction site or anything in repair. So there's some products that take more training than others. And so existing infrastructure, value-add services, we believe that those two things set them apart and kind of box Amazon out for the time being and going forward. Because Amazon would have to, HD Supply has 11,000 associates, and they are driven by having very good associates who are educated on what they're talking about, can go out, sell to customers, can educate customers, and Amazon would have to kind of, by leaps and bounds, accelerate their process, creating an infrastructure to be able to provide customers with that.
Additionally, if you think about, like you mentioned, the bolts and nuts, for each metric size of bolt, you probably have 100 or 200 varieties, and that comes with threads, custom-made sizes, lengths, material type, treating. Amazon doesn't have the scale if they're focusing on essentially every single consumer market in the world, which is what Jeff Bezos made it amazing. He made it fast, but it was everything, but not everything. So HD Supply has things that you can only find in specialty mechanics, hardware shops, things you need trained engineers, trained machinists to make. And as long as Amazon stays the size it is, I think it would have to be 5 or 6 times its size to be able to supply the minutiae quality of the products that HDS has.
What if they just put themselves as the software front and they got their materials from Fastenal, HD Supply? When you disrupt an industry, you don't necessarily compete in the same way as existing participants, right? So they could become the front end. Why would HD Supply have a better front end and interface online than Amazon?
Well, if you're calling an Amazon call center in India, as opposed to an HD call center in Atlanta, you want an expert who's sitting in the call center who has spent time with the company and been trained in their expert faculty center, as opposed to someone who maybe is working as a 3rd or 4th time. Thank you.
Good afternoon, Kennesaw. I'm Jacob.
I'm Jiahui.
I'm Shu. Hi, I'm Chen Ping.
And we're ready to knock your socks off with this presentation on HD Supply today. So as we come out of the gate here, we're issuing a hold recommendation. We have the current price at $44.06, target price at $45.85, and we're showing an upside of 4.07% from the data we calculated as of February 21st, 2019. So as we dive into this company here, we see there are some merits and concerns. Some of the merits are they have a good company image, they have a large coverage with strong customer relationship, and they're a growing company. But some of the concerns we might have here is there's a highly competitive industry, they have a weak financial position, and there's limited upside potential. So as we dive on into merit one right here, we see the company was founded in 1974 in San Diego, California. They got their IPO in 2013. They do business in the United States and Canada, as the U.S. accounts for 97% of their revenue. They have 2 segments to their business, as we have facility maintenance and the construction and industrial white cap. They rank 3rd as an industrial distributor. Outside of their ordinary day-to-day business, they have a very good environmental and social image, as they have environmentally beneficial products that they use in their business and sell to customers. And they also have a month of giving where they raised over $260,000 for different fundraisers and community events. So now as we move to merit 2.
The construction and industrial segment is America's leading supplier of specialty hardware for medium to large contractors. The facilities maintenance segment is a leading supplier of maintenance, repair, and operations products for owner managers and owners of multifamily, hospitality, and commercial properties. Both segments segments have strong customer relationship and has large shares in many local markets. HD Supply has specialized sales experts and solution providers that present value-added services and quick and accurate delivery for customers.
As a growing company, HD Supply has entered into strategic expansion. In 2018, the company purchased A.H. Harris with $362 million. With this acquisition, the company is able to strengthen its wide cap business in the Northeast market with over 50 branches across 12 states. And based on the expansion strategy, we predict that the operating profit margin will increase in the next 5 years. In addition, the company lowered its complexity by selling 2 segments in 2015 and 2017. This action brought declines in the total revenue, but we still predict it to grow steadily in the next 5 years. Because after cutting the segments, the company can better utilize their resources and save costs. This prediction is supported by the increasing revenue of the remaining 2 segments. All 3 of these merits indicate that HD Supply is a good company. However, there still exist some concerns about the health of the company. So now let's move to concern 1.
Here's concern 1. HDS is in a highly competitive industry. Its major pressures comes from existing competitors instead of new entrants. This industry is very fragmented, and many companies are trying to use M&A strategy to get more market share and gain geographical advantage. HD is facing challenge, even though they have the 4th highest market share in the industry.
The second concern is its weak financial position. As we can see from the graph, HD's ability to meet its short-term obligations is improving. However, when compared to the peers, the liquidity ratios of HD Supply are lower. The weak position is even more obvious when it comes to solvency. All the debt ratios of HD Supply are double the peer average, and the interest coverage and operating and cash flow to debt ratios are lower. We can also see the effect on Zhu-Hong analysis. Even though HD Supply has paid down some of its debt, its leverage still remains more than its competitors. Also, the profit margin and asset turnover of HD Supply is the lowest among all the companies. Even with the highest leverage, its ROE is relatively low. We perceive it is a dangerous signal to the financial health of the company due to the future expansion, upcoming debt repayment, and repurchase of stocks.
The final financial problem of HD Supply comes from its inefficient operation and its large amount of credit sale. We can see that the operating cycle of HD Supply went up almost 40 days in 2017. This is due to an increase in the days of inventory on hand and days of sales outstanding. We also got the same result from the receivable turnover ratio and the inventory turnover ratio.
So as we look at our valuation here, we put a 65% weight on the DCF analysis, 25% on the multiple analysis, and 10% on the Monte Carlo simulation, which resulted in our target price of $45.85 with an upside of 4.07%, but don't worry, that's limited.
The reason why we only put 25% on multiple analysis is that the method has limitation. It assumes that the market can value the company correctly. However, we found an inconsistency between the higher than average PE ratio and the lower than average EV/EBITDA. This inconsistency shows that the market is not sure about the true value of HDS. So without considering the capital structure, HDS is undervalued by the market, but after considering it, it's overvalued. Nevertheless, multiple analysis still gave us some insights in determining the intrinsic value of HDS. After we put 60% on EV/EBITDA and 40% on PE ratio, we got a target price of $44.22 for HDS.
For rate calculation, we use the 10-year government bond rate as the risk-free rate, then we regress the daily return data of HDS against the S&P 500 for 5 years to get the level beta. Assuming an equity of risk equity risk premium of 5% and a tax rate of 25%. We can get an 8.2% WACC for our calculation. We expect that after 5 years, after selling water works, it will be easier for HDS to manage their business, which may help them to still keep a 12% operating income margin in 2018. However, we expect that the growth of margin will be slower than before. We believe the margin will grow at 0.5% per year until it reaches 40% in 2022. For terminal growth rate, we use the forecasted inflation rate of the US and Canada times their respective total revenue weight. This calculation gives us a 2.49% terminal growth rate. We believe that after 5 years, the free cash flow of HDS will grow at this terminal growth rate. Here is our 5-year DCF model. After all these calculations, we can get a final equity value which is over 8.4 billion. We divided it by 183.6 million outstanding shares to get a $45.88 DCF price. We rated it as 65% of our final target price because DCF model is more suitable for companies paying no dividends.
So we obtained the distribution of the 12-month target price by running this simulation with 10,000 repetitions. We chose the mean as our target price, and considering that the simulation can underestimate the probability of an extreme bear event like a financial crisis, is the reason we only put a 10% weight on the simulation. So as we wrap up here, we can look back at the merits and concerns of why we think this is a good company. But there's a lot of potential for the stock, which means it can go one way or the other. So we don't think this is very good timing. That's why we're issuing a hold recommendation for this stock. We now like to open the floor up for questions and answers. Well, we have the answers. You guys have the questions.
Could you tell me what would change your recommendation from a hold to a sell, and why? It seems like those risks that you talk about in a higher interest rate environment would be more likely to get worse, not better.
So the thing is, it's the fact that they got their IPO in 2013. It's only 5 years of being publicly traded. We don't really think that's enough time to see if the stock is going to grow and continue to be a larger, steadfast stock. Especially with the bear, especially with how we have a bull market now, you can expect another crisis around the corner. There's just too much. There's just too much going on right now that could happen to say buy or sell. That's why we that's why we want to hold to see where this market runs, to see if this stock can continue to grow, or if they plateau and maybe start to drop.
How much of your hold recommendation would you say is based upon the upside potential of the stock? I mean, I feel like it's pretty interesting that you guys chose a pretty recent stock price to base your upside potential on. I think what, the 21st of February?
Yeah.
2/1. Okay, 2/21. Yeah. So how much of that? I mean, we've had a significant rise in the market since the year started. How much of it would you say is based upon the limited upside versus your perception of underperformance versus the industry or peers or what have you?
So we, the reason we based it off we don't base it with the upside because we don't think that the upside is a very large one. So like I said, we don't want to put too much stock into that when considering this stock. We're not going to have a little word on word play there.
Yeah. So it seems one of your major things is the financial stability of the company. Am I saying that right? So you have one slide there where you talk about it. You put it versus peer companies. I guess, not that you want to keep that a bit further. No, this is one of them. So I guess my question is, you've done various ratios and you show them inferior to the other companies. How much do they overlap with those companies and what does this mean?
So yeah, when we're looking at companies like Grainger, Watsco, and Fastenal, especially, those are companies that are very similar in industrial distribution. Now the thing is that these companies, those three companies have been around a lot longer. They had their IPO for a lot longer. They had their IPO a lot longer ago. So one of the reasons we're kind of, when there's underperforming, but we're not, or we're planning on that, because they are a younger company. So that's when we think they're underperforming. So they haven't had the time to grow and establish as a publicly traded company.
And you had something about the debt was higher, is that right? driver of it, in your view?
You mean that it's a competitor is a major?
I guess my question is, you showed me a million ratios here, and you said you used terms that it's I'm not using the right terms from your slide. I'm trying to
Like when we said a weak financial position.
That's right. So I'm trying, what metric is showing you that it's a weak financial position? I guess that's my real question.
We had this conclusion based on its large amount of debt, and also its solvency situation is not, it's not good enough for them to cover their expansion strategy needs and also their need for repurchase stock, because they think they are undervalued by the market. So they try to repurchase stock every year. Not every year, but on some frequently basis. And then also every year they will use a lot of cash to repay their long-term debt. Like before the IPO, they got a lot of debt. So we see that they have a lot of needs of free cash flow, but they are still they are still borrowing money. So we perceive it as a dangerous signal to their financial health.
Thank you for the presentation. So, what if I come back to you and say that my takeaway from this presentation is sell? How did you convince me that no, what you're telling me is not sell, it's really hold? It's kind of tied to this question.
It's because we're experiencing a bull market right now. Everything's tending to be on the rise. But how long has that lasted? I mean, I understand you could buy now, but we don't really know what the stock could do. We don't know when this market could end. We don't know when it could bear down. How we didn't really see 2008 coming. So it's just, the reason I wouldn't say sell is because we just don't know. There's not enough evidence. Their debt's still kind of high. They're still trying to do all these mergers, acquisitions. We don't know how they're going to play out. So we think it's just a little too risky. If you just hold, keep your eye on it. It's on your iPhone. Scroll down, check it, look at it.
And I want to add one more thing. I think it depends on the levels you can bear the risk. So if you can bear a lot of risks, so I don't think it's a bad choice for you to choose this company. But if you are you are a person who cannot bear any risk, and this company, they have high leverage, so it might crash anytime. So that's my question.
So what you're saying is this is a growth stock that's fully valued? Is that what you're saying?
Yeah, you're asking if this stock is growing to its full value? Well, no, because at this point now where it's at, yes, it is. It's probably maybe considered to be above fair value. I think I know according to other reports and analysts. But right now it is. But like I said, it's only been 5 years. A lot can happen in the next 5 years.
If I was to give you $40, would you buy this company or would you buy one of the other companies?
I'd go with a safer stock.
Which of the stocks would you buy for $40?
Fast, great. They're turning around their operating efficiencies right now. They're increasing their revenues. They're doing larger market extensions right now. But if I had $40, I'd probably just hold on about $40.
What's your assessment of the industry overall? I mean, is it an attractive industry, or what's your recommendation of the industry?
Go ahead.
I would say it's not a really attractive industry because the whole industry will flow with the macroeconomic situation. So if the macroeconomic does good, then people's demand in construction and their position and tenants will increase. So, but however, if the economy does bad, then we don't know about what will happen. So it's really volatile. Like it depends on the macro too much. So it's hard for us to predict how the industry will perform in the future. So that's why if I have money to do some investment, I will not invest in this industry. I will go see some other industry that can better give me a higher upside potential, a higher return, and then yeah.
I'm sorry. So a little bit of a follow-up on that. So it sounds like if there's a certain level of aversion towards cyclical industries in general, I'd say, I guess I would ask, granted, there are some industries that are very cyclical, they're very economically sensitive. But among those, is there anything that you consider attractive or unattractive about this particular industry?
So I'll say that right now in the state of Alabama, they just passed a bill to do infrastructure deals, a lot of construction going on. That's something that this kind of company that attracts to them. That's something that's kind of going on all over the nation right now. The president, he's kind of ordered a lot of more infrastructure, a lot more buildings be built, and that's what does make this company attractive. When that time of frame is going on, when there's a lot of time of development and construction going on, that's when this company would be very attractive. That's when this industry would be very attractive.
So, you have a slide in there that shows the kind of relativity to the industry. Do you mind telling me the exact EBITDA multiple they paid for that acquisition in 2018? And then if we can compare it to the Avria, that 12 times, okay, this is 12 times for the company. What was the multiple paid for that acquisition? I know you talk about the revenue that the acquisition is bringing in, but do you have that number, or if you don't, just let me
The
EBITDA multiple paid for that acquisition.
For the acquisition of AH Harris?
Yes.
Do you guys have that? Like, you ever read it? I'd say I don't think that was something we specifically looked onto.
All right. Then, do you mind go back to the slide with the competitors? Does it show their EBIT? It doesn't. Okay, all right. Well, the point of my question is to see how much they're paying. They're overpaying or underpaying or kind of thing.
Can you tell me what it would take to make this a buy for you?
Just, I'm a kind of.
So, good afternoon. We'd like to thank the Atlanta Society of Finance and Investment Professionals for having us here today. We are Team O. My name is Andrew Schindler. Alongside me are Connor Frondorf and Walker Rainey. Morgan Clanky, our other partner, couldn't be here today. We are pitching a buy recommendation for HD Supply, implying an implied value of $53.11 with upside of 21.8% based on its Thursday trading price. Now, before we get into the presentation, we'd like to go through a brief agenda. We'll go through our pillars of investment, followed by our company overview, look through our valuation methodologies, go through some investment risks, and finally leave time at the end for questions and answers. So, what is HD Supply? HD Supply is an industrial distributor based out of Atlanta, Georgia. For those of you who may not be familiar with the industrial distributing space, think of it like warehouse. Think of it like a warehouser in between the manufacturer and the end user. So HD Supply is a B2B business with two different segments: the HD Supply facilities maintenance business, as well as its construction and industrial segment.
So now we're going to give a brief overview of HD Supply. We're going to get into our three investment pillars. First is that HD Supply is a market leader in two fragmented segments. As you can see in the facilities maintenance market, they had around $3 billion in sales last year. However, there still is over $50 billion of addressable market for them to take. And in the construction and industrial business, we see a similar trend: $2.4 billion of sales with over $30 billion of addressable market. Now, we believe HD Supply will be able to consolidate these industries because of their brand name and their ability for scale and their strong supply chain. Our second investment pillar is around the trend in multifamily housing. Recently, we've seen a shift away from single-family housing to multifamily housing. Now, this is important because the number one cost for apartment complexes is a high vacancy cost. And the number one way to keep vacancy costs low is having a strong repair system in their apartment complex. So HD Supply is able to quickly get parts to these apartment complexes so they can fix or quickly make repairs, and then they can keep those renewal rates high. And the third thing we want to point out here is over 80% of apartment complexes in the United States were built at least 18 years ago, and the average age of an apartment complex in the United States is almost 40 years old, meaning there's a lot of demand for HD Supply to take advantage of. Our third investment pillar is HD Supply's efficient supply chain. With hundreds of thousands of SKUs in inventory, HD Supply is able to offer next-day delivery on the majority of their products, helping their customers quickly keep their operations moving along. Now we're going to give a brief company history. So from 1997 to 2007, HD Supply was owned by Home Depot, and during this time you can see that they expanded their portfolio. Then in 2007, with 8 core business segments, they were LBO'd, and their leverage levels reached almost 15 times EBITDA in 2009. Then from 2007 to 2017, they went through a process of simplification. Went from 8 core business segments all the way down to 2, really simplifying their business and becoming much more focused. In 2013, they IPO'd to pay down some debt, and now in 2017, with a simplified business model and leverage between the 2 to 3 times EBITDA range they're looking for, they have their company where they want it. And now in 2018, they opened their Leadership Development Center here in Atlanta, which allowed them to consolidate their business operations, becoming much more simplified. And additionally, they acquired A.H. Harris, which expanded their construction and industrial footprint in the northeastern part of the United States.
Now, Walker just mentioned the Leadership Development Center, but who's inside that Leadership Development Center? So we want to take away 2 key personnel, Joseph J. D'Angelo, who's the chairman and CEO, and as well as Evan J. Levitt, who's the CFO and Chief Administrative Officer. Both of these gentlemen have been part of HD Supply for a long time, through its LBO process, through its IPO, through its portfolio simplification, and we see them as 2 key pillars moving forward that really provide a strength to HD Supply.
So that strong leadership team Andrew just discussed is overlooking 2 different business segments. The first is facilities maintenance. A good case study here is maybe an apartment complex, multifamily housing. In order to run an apartment complex, you may need anything from light bulbs to machinery for a new renovation. The idea for HD Supply is that they're going to be the ones that deliver that to your door. HD Supply then has 3 specific benefits to going with them versus the competition. The first of which is going to be a huge number of SKUs, over 120,000 in facilities maintenance. This means that when you're running your multifamily housing unit, you can get whatever you need. Secondly, HD Supply has a large number of value-added services. So you may not be a specialist if you're running an apartment complex and a specific type of thing you should be doing. HD Supply then has a very robust team of professionals who can hop on the phone with you and kind of help you out. This is going to be unique from a lot of their smaller competitors. And then third and finally, HD Supply has a very integrated supply chain that allows next day delivery, the majority of which is done by an HD Supply truck with an HD Supply driver. This means that if you need to make a quick fix for your apartment complex, for example, you can get that part as soon as possible. HD Supply operates within 2 main verticals here, facilities maintenance, the majority of which is going to be in the multifamily housing unit, 3 key verticals, the majority of which is going to be in the multifamily unit. This basically means that we're going to see exposure for HD Supply to that strong multifamily environment that Walker discussed earlier, but then also hospitality and healthcare to add a little bit of risk mitigation if the outlook for multifamily housing isn't as rosy as we think it will be. So then the second of the 2 key business segments is going to be construction and industrial. So in our case study of an apartment complex where facilities maintenance is going to be maintaining that apartment complex, HD Supply Construction and Industrial is going to be helping contractors actually build that apartment complex. So the way that HD Supply then generates revenue in this division is to work directly with contractors all the way from the planning stage of building, building, for example, all the way through the final days of execution for building that building. Then the key comparative advantages of HD Supply are going to be similar here. A large number of SKUs means that the contractor can come to HD Supply as a one-stop shop for all of its needs, making it a lot simpler for them. Secondly, the value-added services are going to be key here again to make sure that all the parts are right and working. And then finally, next-day delivery is very, very important if you're trying to keep on a strict budget or time period, for your construction needs. The segment breakdown is going to be both residential and non-residential, meaning we're both going to see exposure to a strong multifamily housing environment that we see going forward, as well as some risk mitigation with non-residential projects as well.
So now, Connor just went through the 2 different business segments, but we know that HD Supply doesn't operate within a bubble. And so we performed a Porter's 5 forces analysis to go and show what the marketplace looks like for these industrial distributors. We've identified rivalry as the key consideration that HD Supply has to take in consideration. They face 2 different fights, one from large conglomerates like HD Supply and similar in size, as well as from more small mom-and-pop type shops that are more regional in nature. And so over time, we believe that HD Supply can go and realize this runway and realize that market earlier because of their strengths in their brand name and their scalability that their other players can't provide. Now moving forward, we visualize this in terms of a landscape mapping. And so you see on the right side, HD Supply sits in the middle between the construction, industrial, and facilities maintenance business, playing with some larger players like Grainger, for example, in the construction industrial space, and smaller and other players like CG&L in the facility maintenance side. On the left side, you see the more regional, localized players like Guaranteed Supply Company that really they service local contractors in nature. And so over time, we believe that HD Supply, they can operate within this fragmented market and then go and continue to gain market share, thus being able to go and reach that target valuation that we had in our offering.
So HD Supply's competitive positioning in the landscape that Andrew just outlined for us is going to lead to our $53 price target, which shows a 21.8% upside for this company. To reach that valuation, we used 3 different valuation methodologies. First, precedent transactions analysis. Secondly, we used a comparable companies analysis, and then finally a discounted cash flow analysis. As you can see with both our precedent comps as well as our trading comps, the first 2 bars up here are both going to show a strong buy for HD Supply, but we feel the company is actually trading at a premium to its peers for 2 reasons. First, operating in 2 key business segments, you're going to see that HD Supply has a very specified and value-added approach, making sure that they're going to be specialized, but they're not too specialized and they can still benefit from some economies of scale and kind of be operating at a much larger scale than its competitors. And then secondly, kind of looking at geographic footprint, we see that HD Supply is going to be operating across the entirety of the nation, allowing them to have a better a relationship with various suppliers, and also allows them to be a one-stop shop for any sort of contractor needs on a national basis. Then looking at our discounted cash flow analyses, we ran 3 different analyses, a base, a bear, and a bull. For our base case, we assume the top line growth would be the same growth, or would be increasing the same rate as it did last year for 1 more year, before stepping down over the next couple of years. But the most interesting bar up here is going to be our DCF bull case. We see that if HD Supply can come out and execute in that market that's going to be ripe for consolidation that we outlined earlier, we can see a price target of a lot higher than $53 if everything goes well. And so there's going to be a lot of upside on top of our $53 price target, which we think is very fair given the comparable companies' precedent comps in our base case for DCF.
Now the economists kind of talked about how we got to our valuation. We realized there are some risks associated with this. Out here we've lined up some of them that we believe, potential regulatory risk, high leverage levels, maybe not being able to realize the runway. But the one we want to focus in on is Amazon. Amazon and HD Supply operate similar or different business models, Amazon in the B2C business space wants to sell as many things to as many different customers as possible, whereas HD Supply in the business-to-business space wants to sell as many things to a singular customer. By doing that, because over 80% of HDS products are delivered by an HDS driver driving an HDS truck, as they ship more to singular end users, the cost per shipping unit goes down and HD Supply gains a competitive advantage over Amazon.
So again, just to wrap up with our 3 key pillars of investment that we discussed earlier, we believe that HD Supply is undervalued, implying a possible buy of $53.31. But thank you for your time. Now open the floor to any questions.
You made the comment that you think that HD Supply warrants trading at a premium versus its peers. What would you say, what would you attribute that to? I mean, how does HD Supply compare to its competitors in terms of returns, margins, growth, those factors?
Yes. So yeah, first looking at the quantitative side of things, we did compare the financials of HD Supply to its competitors. It is growing at a quicker clip. More on the qualitative side of things and why people are coming back to HD Supply is going to be the things we talked about earlier, right? The value-added services, being able to operate at a lower cost because they're on a national scale and kind of seeing the shipping costs go down as they scale, which means that unlike some of the more regional competitors, with HD Supply, the faster they grow, the better their margins are going to get, and that's what we're going to warrant, a trading above our comparable companies. But again, even without that premium added in, it's still going to be a buy recommendation. So we're just showing there could be upside above the price target.
Follow-up.
Sure.
I mean, if you compare them to their national competitors, not regional competitors, to their national competitors, are they operating more efficiently than them?
Yes, so they are operating more efficiently than the conglomerates. So the big boys are going to be like the Home Depots, for example. We thought that those are kind of operating in different models than the 2 segments we're talking about. So that's why our biggest competitor up here is going to be Grainger at the top, which is going to be the biggest kind of in that construction space. But it's very different. We found that there are very key differences in both the financials as well as kind of the value add of companies that are going to be huge conglomerates versus HD Supply, which is going to be very specific in its 2 segments.
And then to add on to that briefly, as you saw with the company history, going from the 8 core business segments down to the 2, it's because they just finished that last year. We now believe that they're kind of a lean machine now. We feel like their margins and their operating efficiency is going to improve even faster than it has been.
Did I understand your analysis correctly? Your precedent comps are based on merger and acquisition, multiple prices? Is that what you're saying?
Yes, sir.
So actually, they can acquire companies at lower M&A multiples than they themselves are trading at.
Could you repeat that? Sorry.
They can acquire companies at lower multiples than they themselves are trading at. Is that the implication there?
So HD Supply, when they go through their acquisitions, the best example is the A.H. Harris acquisition this year went for around $380 million. When they acquire a company, they're looking for a business fit, B, a cultural fit, but in terms of financial pricing, when they acquired A.H. Harris, they acquired it at a multiple below their own, and then when they acquire them, they also want to make sure that they can hope to realize at least one additional turn of run rate synergies through their acquisitions.
Thank you.
It looks to me like the majority of the upside in your price will come from the construction side. If you look at the margins, the way it's growing, how do you get investors comfortable that in the event that we have GDP turnaround, how would the business perform with the leverage on the balance sheet?
Sure. So although the leverage is high compared to its competitors, as you saw in the comparable companies, remember that this company succeeded with the same management structure under almost 15 terms of leverage, showing that even if there was kind of what happened in 2008 all over again, they survived that once. We think that they're kind of set up now to survive it again. However, you can also see if we go to the balance sheet that the company does have a large amount of cash on the books. So if there is some sort of tightening restraint on kind of their debt, they're going to be able to pay that debt down relatively quickly, which would then allow them to operate more efficiently, as you can kind of see the top line being cash, which would then be able to pay down that debt.
Is management committed to delevering the company?
So management right now is very much, they're concerned with making sure that the debt is between 2 and 3 turns. So right now it's at about 2.1 turns. So
that's a no.
Well, they're committed to this point, and they're comfortable with this, so they don't see any need to delever further.
Let's take a slide 9. What happened in facilities maintenance?
So with the drop in margin, so it's actually a couple of different things. One of them is the fact that their DNA kind of fell down. It's worth pointing out that even though it looks like EBITDA margin has fallen, just straight operating efficiency, so operating profit margin has remained constant over the past few years. So that's mostly changes in depreciation and amortization.
What did the sales growth, not the sales growth? The sales growth is flattened out. So let's, I don't know the number, you can tell me graph flattened out.
So I can go back to the income statement, yeah.
So yeah, you can see that their FM revenue growth was 3.1% in 2017, which came down from 7.2% in 2015. We did see a big bump though in their construction and industrial from 6.8% to 10.5%.
And so if you go to the years before, you don't have this on it, if you go to before that, the numbers were highs and it was well double.
Yes.
Well, also that goes in terms with what's going on within the multifamily housing space. So we see that vacancy rates, which are the key differentiator for a lot of apartment complex, they're getting lower and lower, which means it's a more competitive environment. And so we see the way that trends have been working out that the end user, the apartment complex, the super, they want to make sure they have this, they have these parts come in. So they're very concerned. So it's a very steady cash flow stream.
What was the multiple paid for the Harris transaction?
When we were looking into our analysis, I don't remember what the exact one was. However, I believe that HG Supply is trading somewhere in the 10 to 12 range. So when they announced it, they did say it was at a multiple below their own. Yes.
Can you talk to me about the comparison of the PEs for its two big competitors, getting Granger and Fastenal?
Sure.
Why is the market giving them multiples that are higher than HG Supply, and why should I believe that the market is wrong in that? And that, what are you seeing in a company that they're not?
So what happened was 2 years ago, if we actually go to the income statement, there was a big tax benefit for HG Supply. So their last couple of years, their tax rate has been almost 50%. So their PE ratio has been a little bit funky because of that different change in earnings rather than the actual operating efficiency. That's why we use capital structure neutral multiples, EV to EBIT on EV to EBIT, in order to kind of reach the valuation price target. We thought that PE for the specific instance, because earnings were so fluctuating.
But even the EV to EBITDA is still lower. So,
yes.
So my question is what is it about these other companies? What value do you see that the market's not seeing? Because ultimately, they can tell what the tax rates are. They can.
Right.
I mean, the analysts know that.
Well, absolutely. Let's think of it in terms of the company history. So when we see the market, we think they still see HG Supply as this unfocused, 8 different business segments. But really over time, and Walker talked about this a little bit before, we've really gone down to those 2 core business segments. And so we think the market has misidentified this new focus, this focused permanent.
You don't think that they know that they've sold those 2 businesses?
I mean, they know it, but it takes time. Of course, there's prior perceptions moving forward. So we think that it's something to where they see they think of the HD Supply as old rather not than the HD Supply of new that it is today, the move, leaner, meaner fighting machine.
Right. At the end of the day, I mean, the majority of analysts do have a buy recommendation for HD Supply. So we're not betting against analyst predictions here. We could find, out of the analysts that are covering it, no one had a sell recommendation, the majority did have a buy recommendation. So we're in line with what analysts covering this believe, and those that have done really good research right on the company are believing about HD Supply.
Does Fastenal and Razor have the same buy recommendations?
So we didn't look into that more specifically, but that didn't come up. So there was no real irregularities when we were looking at that side.
So if you were to have money, you would spend it on this versus Fastenal or Razor?
Yes.
We would.
Is any of your projected growth coming from additional mergers and acquisitions?
No, sir. So we did model in the increase in revenue that's going to come in the C&I space. That's kind of where we get that big 15% in the next year, but we did not model in any other additional acquisitive growth, just organic growth.
Can you talk about technology and how technology influences their business, and what do you think the risk is from technology disruptor like Amazon?
So for looking at technology on the end user space, so HD Supply has recently added in a new mobile app. So they've always had online ordering. However, now supers and apartment complexes can go on their phone and order new parts. So we feel like that is an additional reason for their growth. And then looking at the comparison versus Amazon, the thing that we see with Amazon, like we mentioned, is the fact that Amazon, because they still outsource a lot of their shipping through UPS, if Amazon ships 5 pieces of equipment to an apartment complex, they have to take up 5 different spaces in the UPS truck. So that means they have to pay for shipping 5 separate times. Whereas because HD Supply has so much of their own shipping, they're only paying for that shipping cost once. So as HD Supply sends more products to individual customers, their gross margin is able to improve.
And building on to Walker's point, HD Supply utilizes an omni-channel approach using both brick and mortar and e-commerce channels. Additionally, when a super will go maybe order PVC pipe, it's not standardized for any of them. HD Supply really gives the end user that customized technical knowledge that they need that Amazon just doesn't do, which is so important when you consider the real pain points that the end user has in the process.
We're in a bull market right now. Why am I paying for this stock at bull market prices when we could have a recession?
Sure, so we did look at so basically, if you just look at our discounted cash flow analysis and trying to take out kind of what people are paying for their peers, which we're paying a discount to the peers, we then just looked at the intrinsic valuation of the stock.
Thank you all the teams and students and volunteers that participated this year, and thank you for the finalists. I understand that it was a close deliberation, but the final winner, local final of the Southern Classic, and who will represent our societies in the regional competition in New York is Team O. Team O is the University of South Carolina. We want to present the cup and also a check.
We'll cup.
We are having a reception for everyone here, everyone involved at Taco Mac, the Kennesaw, Georgia location. It is, I believe it's 6.
Just right around the corner.
Right around the corner, so we all have MapQuest, but it's the Taco Mac closest to this. We'd love to have you there and host you for cocktails and some food afterwards, so please join us. Again, thank you, and best of luck to the University of South Carolina in the regional competition.